Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, April 25th, and you are tuned in to On Trend, the show designed to keep you on the right side of the trend. So we've got the S&P 500 hitting a new high, and I'm going to dive down, look under the hood, and see how the stocks are doing within the S&P 500, 400, and 600, as well as the NASDAQ 100. I'll show you some scanning techniques that I use to do that. Then we'll look at the Invesco or PowerShares High Beta ETF and why we should watch that instead of the Momentum ETF from iShares. We'll look at the frustration of the finance sector and ask if healthcare will follow its script. And then we got some stocks to watch. So the S&P 500 hit a new high. It exceeded its September high. There you can see the gray line there is the closing high on September 20th. And we moved above that high the day before yesterday and hit a new high. And so basically we've come full circle from that September peak to the December trough all the way back. We got this big V reversal in the middle. Basically, it was a 65-day decline and then an 82-day advance. And the advance is still ongoing as far as I'm concerned. The trend is up. Now, you may ask, how did I count these days? Well, there are a couple ways you can do it. But the one way I'm going to show you is I'm going to go to Annotate. And then if you go over to the left of the annotations, you will see the Cycle Lines tool. And I went over and I started with a click and drag, and I dragged that all the way over from the September high to now. And if you look at the bottom, you can see it's 147 days. So if you want to put on some cycles, you can see there's a 27-day cycle. I'm not a big cycle fan, but there you can see it would be a 65-day cycle from peak to trough, September to December. I personally don't use them, but you can use the Cycle Lines tool to count the number of days between a peak and a trough or the length of a pattern or something. I'll sometimes do that. Say this pattern here is a triangle, and you can see that it's basically gone around 34 days or say 7 weeks. So that's sometimes good information to know. So when we look at this chart here, first it's the S&P 500. It does not include dividends. As you'll see the difference on the next chart, which I'm going to show is going to be SPY. And I'll just do that now, to make the comparison good. But you can see we've just edged above that high, pretty much equaled it in truth. And if you look down at SPY, you can see that it is above that September high. And that is because the symbol there at the top, SPY, includes dividends. So this is a total return, basically, index. If you want to get unadjusted SPY, then you have to precede the symbol with an underscore. So underscore SPY would give you the chart without dividends or distributions. Now, the S&P 500 is my main go-to index. It doesn't include dividends. It's the most widely followed index in the U.S., perhaps in the world. And I think the 200-day moving average works as good as any moving average for the S&P 500. It works less well once you get outside the S&P 500 index, but it works pretty good here. So you can see here this big V reversal, and I'm also focusing on, you can see this is the 78-day rate of change, 16.77%. And why 78 days? Well, that basically covers the 2019 advance. So it excludes those first few days up in December. So it's the year-to-date advance up 16.77%. But the main thing to know here is that we hit a new high. We're above the rising 200-day moving average, and things are bullish. Sure, they might be overbought, but overbought is more bullish than bearish because it takes strong buying pressure to become overbought. So now we're going back to SPY, and I've got the 78-day rate of change in the lower window, and you can see it's at 17.44%, so it's more than the S&P 500, and that is because we have a dividend added in there into the price series, and that, of course, is why we have the new high. And so that's another reason why I really don't use support and resistance, maybe short term for SPY, but definitely not long term, going back over 6 months. I'm not going to look at that as a resistance level, especially on a dividend adjusted chart. But what I'm going to compare is basically the performance over the last 147 days. And so the SPY is up a little bit over the past 147 days because it's above that high. And I ran some scans, and you can see the results there. And of the 500 stocks in the S&P 500, 51.8% are up over this 147-day period. So 48.2% are down. So a little more than half are up. The average gain is a little bit more than the average loss. That's a pretty split market. So the S&P 500 is pretty much at its high. SPY is just above it. And the index reflects it. The performance of the components reflects it because you have a split within the market. And that tells you it's really a stock picker's market out there. Now, when we go down and we look at the NASDAQ 100 or QQQ, we can see performance improves. So 59% of stocks in the NASDAQ 100 are up since this September high here. And the NASDAQ 100 QQQ is up. And only 41% are down. So it's performing much better than the S&P 500. The components are. You can see the average gain is 17%. Average loss is 13.5%. So this is where the strength has been in the NASDAQ 100. No big surprise there. Now, you can see performance starts to deteriorate when we go down the market cap scale. So now we're going from large caps to mid caps, and this is the S&P Mid Cap 400 ETF. And if we look at the stats box there, we can see less than half, 42.7% of stocks are up since September, and 57% are down. So the majority are down, and you can see MDY remains below that August-September high there. And the average loss of those decliners is more than the average gain of those advancers. So mid-caps are still struggling, especially internally, over the last 6 months or so. And then it gets even worse when we go to the small cap indexes. So I'm showing the chart for IWM, but I ran my scans using the S&P 600. And you can see here that 31.5% of stocks in the S&P 600 are up since the August high there. It peaked earlier than the S&P 500, and 68% of stocks are still down. And that is reflected in the index because you can see that it would take another 9% advance in IWM to get back up to that high. So small caps are still lagging considerably in this rally that we're seeing here. It's reflected in the components individually. It's reflected in the broader indexes like index ETFs like IWM and IJR. Is that bearish for the broader market? Well, I'm not going to say that because the S&P 500 is still the 800-pound gorilla in the room. These small cap indexes account for like 8 to 10% of the total U.S. stock market. So like 1/10 of the U.S. stock market. So that's like the tail, all right? And the tail does not wag the dog, I'm sorry. Until the S&P 500 breaks down or shows some sort of bearish signals in breadth, I'm not going to become concerned with underperformance from small caps. Now, even though small caps are lagging on the chart, if you look at this perf chart, which shows year-to-date performance for some major index ETFs, you can see they're listed at the top. You can see they're all performing pretty much in line. There's the S&P 500 SPDR SPY, and it's up 17.5% year-to-date. The Russell 2000 is up more, 18.36%. So in that instance, it's outperforming. And IJR is up 15.88%, so it's underperforming. Mid caps are up more than large caps this year. So it all depends on how you slice it. But as I've said before, I think this trend that we've got going, this advance that we got since December, and the broad market indicators that I have turned bullish in mid-February and they've yet to turn bullish, that's the most important trend to watch. It's not that September high there or the August high for small caps. We need to watch this trend that's been going on since the beginning of the year, basically. And as long as it holds up, then the market is in bull mode. So you might be asking, how did I run that scan? And it's a really easy scan, okay? On the top of this scan editor, you can see I've got the major indexes. I've got the NASDAQ 100 group is, S&P 500, S&P 400. And you see the gray forward slashes before each of these. Well, that means the scan engine is ignoring what is to the right there. So I'm ignoring these first three lines, and I'm only focusing on group is SP 600. So I'm scanning for that, and I want the rate of change, 147 days, which goes back to September 20th. I chose it because it's the S&P 500 high, is below zero. So if I wanted that to be above zero, if I was looking for positive rate of change, I would just change that arrow to above zero. And then the last line is rank by. And I chose to rank by this indicator, the 147-day rate of change. And so I will go down and click Run Scan, and we will see the results of this scan and see that very few stocks in the S&P 500, relatively speaking, are above their or are positive over the last 147 days. It's 189. You can see all of those. And I can remove some columns. We don't need exchange. I'll leave out sector and universe and volume. And there you can see we're sorting by the daily rate of change, 147 days. The biggest mover is Diebold, which is up 163%. And of the ones that are positive, VAD is just barely positive. Now, if you don't know the terminology or the code for a particular index, you can always go down to the scan components section. So if you don't know rate of change, you could go down and you could insert this indicator using this drop-down menu that I am showing here. You just scroll down. There's a whole bunch of indicators you can use. There's rate of change. Click Add, and that will be added to your scan code. Also, if you want to look at a particular index or ETF, there's the NASDAQ 100, S&P 500, and so on. So I can insert the S&P 500 just by clicking that. And then when you go down, you'll see where they are. Now, you're probably going to have to move those. Looks like S&P 500 didn't get added, so I'll click it again. And there we have S&P 500. So you have to do a little cut and paste to move it up to the top, because you can't have that at the bottom. So that's how you can add those real easily. Now, one of the arguments I've been hearing against the bull market is that momentum stocks are underperforming low volatility stocks, and that suggests to you there are not animal spirits in the market. Now, as I showed from the breadth indicators at the beginning, the market is pretty split, and then it turns negative when you look under the hood for mid caps and small caps. So that is a negative overhanging. But I want to clarify this problem or issue with momentum and minimum volatility ETFs. As with any ETF, you need to know the components to understand what makes it tick. So here's the MTUM, which is a momentum iShares ETF. And you can see that, it's doing all right. It's been rallying since the December low, and it's above the flat 200-day moving average, but it is below this high here. So it is underperforming in that regard. You look at the minimum volatility ETF, it is outperforming because it hit a new high in late February and again in April. And then if you look at the momentum relative to the low volatility ETF, you can see that momentum has just performed in line since November. Momentum is not outperforming. And we can't really say it's underperforming because it's just a flat line, basically. Now, in order to understand what's driving these, we need to understand what is in them. So let's go to the iShares website and take a look. So I'm here on the iShares website, and I just want to know the components for this momentum factor ETF. And before I look at them and show you, just think in your head what you think the top sectors might be, or the top sector might be in this ETF. Maybe you're guessing information technology. Well, let's see if that fits our expectations here. You can see a lot of details about the ETF. And then you look at the top holding and okay, we got Microsoft up there, but then we got Procter & Gamble as the second biggest holding, and Johnson & Johnson and Merck and Pfizer. They don't sound like momentum stocks to me. Cisco, yeah. And then when we look at the exposure breakdowns, we can see that healthcare is the single biggest sector by far, 30% of this momentum ETF. So if you want a lot of exposure to healthcare, then yeah, you should be in this momentum ETF. If you want exposure to consumer staples, which is the third biggest sector, then you want to be in this momentum ETF. And to me, that doesn't make sense. Now, if we go over to the minimum volatility ETF, we can scroll down and we can see the portfolio and the number of stocks, the top stocks. We got Visa, information technology. Okay, that makes sense. But you can see the weightings are relatively small in this one. Fiserv is in there. And then if we look at the sector breakdown, it's kind of reversed. Information technology is the top sector at 17%. And then we've got healthcare and we got financials. So there's not a lot of what I would say momentum stocks in this by the weight. It's being offset by healthcare and financials and staples. Those three sectors are accounting for almost 40% of the ETF. And that would explain why the momentum ETF is not outperforming the minimum volatility ETF. So I think the main takeaway here is do not use these ETFs, momentum and minimum volatility, as a proxy for market risk, because their components do not suggest above average risk or low risk, if you ask me. If you look at the Invesco PowerShares ETF, they also have a momentum ETF and a low volatility ETF. And you look at the ratio here, which measures relative performance, it's a similar picture. You can see that the momentum ETF has yet to hit a new high. The minimum volatility ETF hit a new high in February. And the momentum relative to minimum volatility ratio has just been flat since November, gone nowhere. So neither one is outperforming or underperforming, really. So these do not really reflect what's going on in the market as far as technology in particular. Now, to get a better idea of so-called animal spirits, I think we can use the high beta ETF relative to the low volatility ETF from Invesco or PowerShares. It's not as good, or not, it's better than the other two, basically. But you can see this high beta ETF is near its highs. It's just below, so it is yet to hit a new high. The low volatility ETF hit new highs there in February as well. And we can see a little bit of outperformance here from the high beta ETF because it got a breakout in April. So that shows a little bit of movement into high beta stocks. Now, when it comes to high beta stocks, I think there's really one sector we need to go to, and that would be the technology sector. And if we're going to look at the technology sector, we need to look at the equal weight technology sector. So I think RYT is as good of a proxy as any for the high beta end of the market, or the higher risk, higher volatility stocks. You can also look at small caps because they tend to have higher betas and higher volatilities. But technology is a purest play, because you've got, and especially if you get into mid cap and small cap technology. But if you look at this is the equal weight index from the S&P 500. You can see that it did hit a new high. And we can see that the equal weight technology sector hit a new high there in March. And if we look at the ratio of technology to equal weight S&P 500, you can see it was breaking out in late January and early February there. And so that was the early sign that technology was leading. And technology has just been on a real tear in February, March, and April. Yeah, it's getting extended, but clearly, this is the higher risk end of the market and money continues to flow into it. And so I think that's net positive for the broader market. So the finance sector has been one of the most frustrating sectors to analyze, but one thing that is sure is it's not one of the leading sectors, all right? It has yet to hit a 52-week high here in 2019. So there are other sectors like consumer staples and technology that are stronger, consumer discretionary as well. And you can see that it just moved above that March high. So it's finally, gotten back after the March decline there. But what makes it frustrating is it's kind of this, this broadening formation. And I'm not going to call it a bearish formation. It's just widening swings and more noise as far as I'm concerned. But what I think is the main thing here is that, we did have a kind of a resistance zone there, and we've broken above that zone, and we're holding above it. But if we go back below the 200-day, then it'll be back to the normal frustration of the finance sector. And one thing you can also see is that, RSI has not made it above 70 this year. And if you look at these other ETFs, RSI has made it above 70. And so that tells you, even though we're getting some upward, traction here, we're not getting momentum because RSI cannot get above 70. So my preferred way of analyzing these sectors is using the breadth indicators for signals instead of the price charts. And I talked about that on a YouTube video that was posted in the second week of April. Here I am on the homepage for stock charts on YouTube. And if you scroll down there, you can see the Welcome to Stock Charts, Market Watchers Live. Then you've got the morning shows. And you can click View Full Playlist under any of the morning shows to see all of the shows that have been posted. And on the right-hand side, you can see the videos that I've posted over the past few weeks. And so this one is called Breath, Whipsaws, and Spiders. And if you click on that video, then you will get my take on using these breath indicators for signals. So, going back to finance, and I fall into the trap of looking at the price too still, but, we had this nice flag and it looked like we had a flag breakout and a deep pullback, but we had a higher high. And then we got what looked like a support break here with that sharp decline I showed you. And so there's a lot of whipsaw going on here. But if you relied on the breath indicators, and no, this is not going to work perfect every time. Of course, there are going to be whipsaws with breath indicators. But you can see we basically had two signals in the last 6-7 months. We got the October bearish signal there, and it was pretty timely, right when we broke below the 200-day and below that September low. And that's because we had a bearish signal from the 10-day EMA of 80%. It moved below minus 30%. We had the percentage above the 200-day EMA moving below 40%. So that was when two of the three were bearish. That was net bearish. And then the third one, high-low percent, moved below minus 10% a couple of days later. And so these indicators stayed on bearish signals until we had two of the three triggering bullish in the middle of February. So the percentage of stocks above the 200-day moved above 60% in mid-February there. Prior to that, we had the breath thrust in the middle of January. So at that point, two of the three were bullish. And then we had high-low percent moving above plus 10%. So in the early part of March, all three were on bullish signals. But then we got a bearish signal about a week later with 80%. And we got a bullish signal again because it got some whipsaw there. And then we got a bearish signal there in March. But you can see because of this down and back up, we were still net bullish. So we didn't get two of three at the same time bearish in March. So this indicator group stayed bullish during this decline here. And you can see 80% did not go back below 30%. And then we got the percentage above the 200-day back above 60% in the first or second week of April there. So finance is back on a bullish signal. And so I would still be bullish of the finance sector. Now, the second most frustrating sector out there has got to be XLV because it's kind of following the same script. I'm thinking, well, we don't have a broadening formation here, but we do have is underperformance. Clearly, XLV is the weakest sector of the 11 because it is below that March low. It formed a lower high in February there, and you can see this breakdown. But there I go, falling into the chart trap of marking the breakdown when I probably should go to the breadth indicators because the breadth indicators, one triggered bearish, but two are still bullish. So even though it's not the preferred sector out there, it's still not fully bearish as far as these breadth indicators are concerned. And it is a bit interesting because RSI is moving up from oversold. It's moved above 30, and we're getting a little bit of a bounce. So at the very least, we could get a bounce back to this 89.90 area for XLV. Now let's look at the breadth indicators. So here are these same breadth indicators applied to XLV, and you can see that we got the initial breadth thrust like the rest of the market there in the early part of January. We got the second signal triggering when the percentage above the 200-day moved above 60%. So this sector was net bullish here at the end of January. And then we got the percentage above, or the high-low percent indicator above 10% to make all three on bullish signals. So the first bearish signal has been the 10-day EMA of 80% moving below minus 30%. That's kind of like a downward breadth thrust. And it's the most volatile of these indicators and the one to trigger, and that's why I look for confirmation from one of the other indicators. But they have yet to trigger. So high-low percent has yet to move below minus 10%, and the percentage of stocks above the 200-day is yet to move below 40%. So this one is interesting for an oversold bounce, but again, there are other sectors that show more strength in healthcare right now. So I was looking over the charts, and Bank of America came up as one that could be the next or one of the next stocks to make a new high. That's another way I look at charts. I say, well, what stock has a really good chance of making a new high? And in order to make a new high, it's got to be at least fairly close to a new high. And if you look at Bank of America here, it had the sharp move down with the rest of the finance sector, and it firmed for a little bit, and then had the gap up and the move back up. So that's kind of like a really strong bear trap. So basically we've had a move from say 26.5 to 30. That's a pretty strong advance. A tight consolidation is like a high and tight flag or a pennant. And these are typically bullish continuation patterns. And if we get a breakout there, that's going to argue for new highs in Bank of America. So this is one finance stock I would be keeping an eye on. Now, F5 just reported earnings, and they're all over the place today. But before I look at the daily chart, I want to look at the weekly chart for some perspective because I think this one is at an interesting juncture, perhaps. You can see a resistance level turning into support around 150 here. You've got this big advance from October 2017 to September, and this is retraced around 50%. You don't need the Fibonacci retracement. You can eyeball it and see it's about close. And then we're establishing support in that 150 area, and we've got this surge. So, the weekly chart is looking like it's setting up for a breakout. Now, if I go back to my original daily chart that I've got here, we can see that there's the wedge in detail, and we've got this big surge, a flag-like consolidation, and if we can get a breakout above 170, especially after today's volatility, I think that's going to be a bullish development for F5. All right, and that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.